Good afternoon, good morning, wherever you are. Thank you for joining us today. Little video.
Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the ON24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. Our poll questions will also appear in the slide area. Be sure to click directly on the slide to answer poll questions throughout the webinar. You can resize these widgets for a larger or smaller view. You may follow along also with a PDF version of the slides that can be found in the related content widget. The CPE criteria section details the requirements you must meet to receive full credit for CPE in this session. To obtain CPE, you must do two things. First, be on the live webinar for at least 50 minutes, and second, respond to 3 of the 4 polling questions that will appear throughout the presentation. You can track your viewing progress in the Earn CPE widget on your screen throughout the webinar. By registering for today's event, you will automatically receive an email after 24 hours with a link to download the slides and a link to view the recording. Additionally, if you meet all the criteria and qualify for CPE, a link to your CPE certificate will be in that email as well. Please remember that it does take 24 hours for that email to be automatically generated, so look for it sometime tomorrow afternoon. For CPE-related questions, please reach out to cpe@yptc.com. In the related content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the speaker bio section, you can find more about our presenters, including their contact information. If you need technical assistance, please use the help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
All right. Welcome, everybody. This is YPTC's first webinar of the year, so thank you for joining us. And we're going to be kicking things off a little bit different than we've done in the past. We have a little game show for you today, and hopefully you'll do great testing your knowledge on nonprofit financial reports and nonprofit accounting. So first, let me introduce myself. My name is Greg Indictor. I am the Regional Director of the Central New Jersey office of YPTC. I'm your part-time controller. And joining me today is one of my colleagues from our Central New Jersey office, George Stout. George, say hi.
Hi, everyone. Good to see you all. As Greg mentioned, my name is George Stout. I am a manager in YPTC's Central New Jersey office. I've been with the firm since the summer of 2010, so just about 15 years. I was only 6 when I started with the firm. So YPTC is a professional services firm specializing in nonprofit financial management. Our organization was founded in 1993 in Philadelphia, and we have over 3 decades of nonprofit expertise. Our services include all things nonprofit accounting and best practices, budgeting, reporting, data visualization, grant tracking, just to name a few. We currently serve over 2,000 clients in just about every state across the country, and these numbers grow every webinar. We work remotely and from our 13 regional offices nationwide. Our learning objectives for today. First, to identify the components and key features of nonprofit financial statements. Secondly, to explain answers to common questions about nonprofit accounting best practices. And third, to recognize factors that influence financial reporting, accuracy, and compliance. We will accomplish our learning objectives in an unconventional way today. As Greg mentioned earlier, our session is all about games and competition. First, we'll provide a foundational understanding of the components, functions, and key features of nonprofit financial statements. Then we'll explain how the game rounds will work. We'll get right into our core game rounds where we'll be testing you on nonprofit financial statement basics, compliance, and controls, and also other best practices such as financial oversight and management. And finally, we'll wrap things up with a summary. So as you can see, we will cover a wide variety of topics today, and there will be lots to learn, whether you are a seasoned pro or just getting started in the nonprofit world. Now I'll hand it over to Greg.
Great, thanks, George. So for our first learning objective, we're just going to do a brief overview about nonprofit finance and accounting, just to give you an overview. And this will be sort of the foundational concepts related to nonprofit financial reporting. Some of these topics I'm going to present could be in some of our questions later on in the quiz. So make sure you're paying attention. When we go through our quiz, our questions are going to increase in difficulty, and some of the questions will not relate to the topics I'm going to discuss now, but that's what's going to make it exciting. So first, accurate financial reporting isn't just about compliance. It's about trust, sustainability, and impact. Nonprofits operate in a unique environment where financial transparency directly affects your reputation and your ability to fulfill your mission. Think about it, that donors, grantors, stakeholders all rely on the information that we provide to them, and we are in the age of information. And when your financial statements are clear and precise, it demonstrates an accountability and builds confidence. That can lead to more funding opportunities, stronger partnerships, and long-term success. On the flip side, errors and inconsistencies can lead to more than just headaches for the audit. They can jeopardize funding sources, risk your nonprofit's tax-exempt status, and even undermine your mission. And no one wants to explain to a board why a grant was revoked due to incomplete records. But don't worry, this is exactly why we're here today. This quiz is designed to help you sharpen your skills, spot common pitfalls, and test your knowledge in a low-pressure environment. So to do all this, first we're going to start at the top and see where all of our accounting guidance comes from. The rules and regulations that we follow in the United States are referred to as Generally Accepted Accounting Principles, or GAAP. GAAP is issued by the FASB, the Financial Accounting Standards Board. Now, that's an independent standard setting board that establishes the financial accounting rules and reporting standards that non-governmental agencies, under which nonprofits are included, must follow. In short, we look to GAAP to guide us through our accounting principles. All right, let's start back at the bottom and talk about some key financial terminology that we use in nonprofit accounting, or even in accounting in general. So first, let's talk about a fiscal year. A fiscal year is a 12-month period that an organization uses to report its finances. It doesn't have to be a calendar year, and often an organization is going to choose a fiscal year that relates to its operating cycle or major funding sources. Next, our accounting records are maintained in an accounting system that we call the general ledger. Transactions that are processed are recorded here, and such as your bank accounts, merchant accounts, payroll accounts, they all flow into the general ledger. Now, within the general ledger, we have the chart of accounts. This is where transactions are coded to track various activities, assets, liabilities, income, and expenses. Now, most accountants follow a basic structure in designing the general ledger, and there are some general guidelines that we do follow, but every organization's chart of accounts is going to be different. A standardized chart of accounts helps with consistency and understanding, but we also want to make sure that we're capturing the nature of each organization's activities as well. Finally, we have what every accountant and auditor relies on to make us happy. These are sound systems, processes, and procedures. We refer to those as internal controls. Internal controls like segregation of duties and limits over control over the financial function by dividing Critical tasks within a transaction across multiple individuals means that no single person has the authority or control to approve and record transactions all on their own. Effectively, if we can prevent one person from controlling all this, it does have a stronger possibility of preventing or identifying fraud. Now, there are two main ways that we do our accounting methods. And nonprofits, they're either going to choose from what we refer to as the cash basis or the accrual basis. On the cash basis, activities are recorded when money is received or money is dispersed, regardless of anything besides what's happening through your bank account. Now, this sounds pretty simple, but one major issue is that this is not in accordance with GAAP. This does not follow our GAAP rules. That means if a financial statement is audited and it's presented on the cash basis, that financial statement cannot receive a clean opinion. Instead, what GAAP requires is the accrual basis. And on the accrual basis, we record revenue when it's earned and expenses when they're incurred, regardless of when the money comes in and out. Now, many nonprofits choose the accrual basis, which is great, but some may choose the cash basis as well if, let's say, they're below audit thresholds or funders aren't requiring it. Still, we always recommend to our clients that they use the accrual basis. It's a better way to report to give us the ability for comparisons to budgets in prior years and consistency throughout the fiscal year. Now, we just discussed a couple of key differences between for-profits and nonprofits. I want to go through a more all-encompassing list. And first, let's talk about what we refer to as what would be in the for-profit world equity, but in the nonprofit world, our net assets. And that's when we look at our assets less our liabilities, what that remaining amount is. For-profits have equity because there's ownership. In a nonprofit setting, there is no ownership. No one owns the net assets of the organization. That's for the general use of the mission. And when an organization would dissolve, those remaining net assets actually would not go to any one person. They would go to another nonprofit or back to the state that the organization was formed in. So we do not have equity in a nonprofit. Next, when we look at our activity for the year, our revenue less our expenses. In the for-profit world, we call that a net income or net loss. In the nonprofit world, we just simply refer to that as the change in net assets. Our financial statement titles are different also. In the for-profit world, we have a balance sheet and an income statement. In the nonprofit world, instead of a balance sheet, we have the statement of financial position. And instead of the income statement, we have the statement of activities. They're roughly going to be reporting the same information, almost in the same format, just the titles are different. And one of the major differences between for-profit and nonprofits are contributions. For-profits can certainly make contributions, but only nonprofits can make and receive contributions. In terms of expenses, the way we handle expenses is virtually the same again in both for-profit and nonprofits. In the for-profit world, we just report our expenses in the statement of activities or the income statement. In the nonprofit world, we have to do that, but we also have to do a separate functional reporting of expenses. We'll talk a little bit about that shortly. As I mentioned, contributions are huge for nonprofits. It's the major difference. But nonprofits can also receive earned income as well. And understanding the difference between them is a major issue related to nonprofit accounting. A couple months ago, we did a webinar called Look Over Logic, and we discussed this topic in great detail, so check that out on our website. In general, when we're dealing with earned revenue, we're dealing with some sort of a contract. And what would identify income as being earned income are two major factors. One is it is an exchange transaction. There's reciprocity. A resource provider is giving something to the nonprofit, and the nonprofit is doing something in return, providing goods or services. The other key term we use in this concept is commensurate value. They are returning commensurate value for those resources that the resource provider is giving the nonprofit. Dealing with contributions, a contribution is an unconditional transfer of assets. There is no reciprocity. We're not giving anything back. There's no exchange of commensurate value when we're dealing with a contribution. And promises to give, that's the term we use related to contributions, or at least the agreement for a resource provider to give a contribution. That could be written or it can be an oral agreement. When we're dealing with our clients, especially around audit time, a written promise to give is a lot easier to support than an oral agreement, but it can come either way. As we work to discover what type of income we have and the accounting treatment of that income, we like to use this flow chart. It describes the step-by-step actions that we take in our decision process. At first, we're going to look at whether we have earned income, an exchange transaction, or do we have a contribution? Next, once we establish that we have a contribution, we have to identify if there are only any donor-imposed conditions. A donor-imposed condition is going to affect the timing of how we record and report that revenue. If a donor imposes a condition, which is like a barrier, something that has to happen before the organization is entitled to those funds, to what is promised. And the donor presents some kind of a right of return if that condition is not met, if that barrier is not reached. If that is the case, there's a barrier and a right of return. We do nothing at that point in time. If once we reach or complete that barrier, whatever that is, or if the donor gives us a contribution that has no conditions to start, we are able to record that contribution and report that income. How we report that income, though, is going to depend whether the donor has imposed restrictions. And a restriction made by the donor is going to limit those funds for a specific use or to be used during a specific time. Now, notice the word donor in both the conditions and restrictions. That's because only a donor can impose conditions and impose restrictions. If the board of an organization would like to set money aside for a rainy day or for some future use, we do sort of carve that out, but that is just that is considered without donor restrictions. Only a donor can impose restrictions that affect how we report our revenue. So let's take a deeper dive into our nonprofit financial statements. As I mentioned, our balance sheet in the nonprofit world is called the Statement of Financial Position. In there, we're going to look at the organization's assets and its liabilities. And that difference between them, again, as I mentioned before, is our net assets. Now, assets are things that the organization owns, and liabilities are things that the organization has an obligation to pay. Typically, when we show our statement of financial position, we're going to order the assets in terms of their liquidity, how close to cash that asset can be turned, or how close that asset can be turned into cash. And the most liquid assets are presented at the top of our asset list, and the ones that are not liquid, we can't easily convert those to cash or shown as long-term or other assets. Same thing for liabilities. What are the liabilities that are going to be due in the next 12 months? Those are our current liabilities. That could be a credit line, accounts payable. If we have loans with the bank that have repayment terms that are extended past 12 months, those are going to be our long-term liabilities. Our income statement, or again, as we call it in nonprofits, are our statement of activities. And they're going to report the revenue and the expenses of the organization. Now, revenues can come again from providing goods or services or by contributions received from our donors. Expenses, of course, are the cost of doing business to whatever our programs are, our support or overhead costs. That difference between our revenues and expenses is again called the change in net assets. In addition to reflecting the expenses in our income statement, nonprofits also have to do additional reporting. We have to, whether it's a statement in our financial statements or in the footnotes to the financial statements, we have to show expenses by not just their natural classification, which is like payroll, supplies, rent, but also by their function. And nonprofits are reporting on two major functions. We have our program services, and we have our supporting activities. Our program services are what we're doing to benefit our stakeholders, society, the public, what we're doing to fulfill our mission. Support activities are the activities that help support the organization as a whole. And they're subdivided into two categories: management in general and fundraising. If you're a membership organization, we might refer to fundraising as membership development. Now, our supporting activities are also, in a sense, the overhead of the organization. Not only are we doing this for our financial statements, but Form 990 also requires us to report our functional expenses. It's a schedule within Form 990 as well. Another statement that is required is our statement of cash flows, and this is for both for-profits and nonprofits. And they're pretty much the same, very slight differences between those. But when we show a statement of cash flows, we are showing the activities of cash coming in and cash going out of the organization, and we do that in three different buckets. We have our investing activities, what we paid for in fixed assets, or if we lent money out to people, that would be investing activities. We have our finance activities. This is when we are getting funding. Maybe we are getting a loan from the bank, or a donor has provided us with a long-term asset. And then finally, everything else, that's our operating activities, sort of the normal everyday transactions that we use to produce income and fulfill our mission. Here's an example of our statement of financial position. As you can see, we have our assets and our liabilities. On the left side here is our assets, and we have broken it down between the current. Those are the most liquid assets, the ones that can be converted to cash, and what can be converted to cash within 12 months, and then our long-term assets, including our fixed assets, are long-term. On the right side is our liabilities and our net assets. Again, our liabilities are ordered by how close they are due within the next 12 months. And then our net asset sections at the bottom. What makes accounting easy? It's a puzzle. And in this puzzle, we already know the answer. Our assets have to equal the sum of our liabilities and net assets. That's why we call it a balance sheet. Now, you notice that our net assets has two lines. We're going to report the funds that we are carrying forward into two categories. One is our net assets that do not contain any donor restrictions. And the second line are the net assets that do contain donor restrictions. As I sort of alluded to before, if the board has designated money for the future, that would still be represented in the without donor restriction line, because that was not donor imposed. Here's our statement of activities. And in our statement of activities for nonprofits, we're going to report the activities, the revenue and expenses and change in net assets, two ways. One is the activity without donor restrictions, and one is the activity with donor restrictions. This is the common format that we use, a column or approach, one column for without donor restrictions, one column for with donor restriction, and then a total column. This is not a required format. An organization can choose to show one column and the without donor restrictions on the top, Then the next section would be the with donor restrictions, and at the bottom is the total. So there is no prescribed format, but this is the typical presentation style that we do see. As for reporting on functional expenses, it's most commonly done on a report like this, the statement of functional expenses. Again, we can do this in the form of a footnote in a footnote to the financial statement. And here you can see the rows represent our natural classification of expenses: personnel expenses, food service, camp insurance. And then you can see the columns represent our function. We have our program function, and then we have our management in general and our fundraising. The management in general and fundraising together would represent our support services of the organization. And finally, our statement of cash flows. I mentioned those three buckets, and they're presented here. And there are three sections. We have our operating activity, our investing activity, and our finance activity. And they all roll forward to our change in cash flows for the year. And then looking at what our cash was at the beginning of the year, we know what our ending cash balance is. Again, we're dealing with a giant puzzle. Our ending cash balance, represented on the statement of cash flows, will agree to the cash presented on the statement of financial position. All neat and tidy. Our puzzle is solved.
Great job, Greg. That's a lot of good information. So now that we have the foundation of our discussion laid out, are you ready to test your knowledge? First, we're going to go over some game rules. We're going to begin to play a song, just a few notes of a song. If you think you know the name of the song, but
George,
folks, I'm
sorry.
Game. I'm sorry, folks. That's a different game show. I work on quite a few game shows. My apologies. Oh, here we are. Playing along with us today will require your engagement and participation. We will be utilizing the poll function in this On24 platform to garner answers for each of the questions that we pose. We will have 4 total rounds, increasing in level of difficulty from easy to expert, and corresponding point values as we move along. In order to play with us, you must track your own scores and self-report at the end, just like an audit. Our first 3 rounds will have a total of 13 questions, 5, 5, and 3, and then we will have 3 expert level questions that could make or break your score. There will be a total of 390 points to win. As noted by our introduction video, only 3 responses are needed for CPE credit. However, there'll be plenty of other opportunities, and we'll be triggering a total of 16 questions using our poll function. The questions will appear directly on the screen where the slides are now. See the example on this slide for a sneak peek of our first question. Each poll question will be open for 30 seconds, and after closing the poll, we will provide the correct answer and an explanation. Due to the functionality of this platform, again, we're unable to track your answers for correctness. So if you are super competitive, then we recommend tracking which answers you get correct. And at the end, we want to hear how you did. So Greg, let's head into round 1.
All right, what would be a game show without a 1970s game show host microphone? So here I go with our first question. Again, this is our easy round, and these easy round questions are worth 10 points. Our first one is, where can you find the accounting of financial reporting rules for nonprofit organizations? Is the answer A secret vault guarded by nonprofit unicorns? FASB ASC 958, whatever Carol from finance says, or GASB statement number 34. We'll see how everyone responds here. Looks like we have people already chiming in with answers. I'll give you another 10 seconds to respond.
You know, Greg, speaking of Gatsby, when I was in college, we had to read The Great Gatsby. I had no idea that was a book about accounting.
Yes, well, no, it wasn't. But
Oh,
anyway, let's see the answer. All right, the answer to the question is FASB ASC 958. Topic 958 in our accounting standards codification provides us the guidance for accounting standards for nonprofit organizations or non-governmental entities.
we should mention that governmental agencies have their own set of standards, which are established by the Government Accounting Standards Board, or GASB for short. Fun fact, both the FASB and the GASB are themselves not-for-profit entities. Well, it was a fact anyway, Greg. The FASB then compiles and releases these standards into one authoritative source known as the Accounting Standards Codification, or ASC. When the FASB makes changes to the ASC, it releases them as accounting standard updates, or ASUs. So when the new guidance come out, you may hear accountants refer to it by its ASU number until it gets folded into the ASC. And they do that PDQ.
Yes. Thank you. All right. It looks like 81.5% of you got that answer correct. So very good. Give yourself 10 points. All right. Our next question, 10-point question. Which financial statement provides a snapshot of a nonprofit's financial position at a specific point in time? Is it A, the statement of financial position, B, statement of activities, C, statement of cash flows, or D, the statement of functional expenses? All right, get your answers in, and we'll see if you guys were paying attention a little bit earlier. We definitely discuss each of these statements in our first learning objective. All right. If you guys are ready for the answer, the answer is A, our statement of financial position, or the balance sheet, as like it's called in the for-profit world. And this does provide us a snapshot, a moment in time of what the assets, liabilities, and net assets were of the organization. All right, let's see how you guys did on that question. Oh, even better for this question. Almost 90% of you got it right, so good job. All right, our next question, number 3 of our first round. Which of the following is typically not a responsibility of an executive director? So which one is not a responsibility? Is it A, overseeing the daily operations, B, bank recs and bookkeeping, C, fundraising and strategic planning, or D, acting as the face of the organization at events? Now, I would imagine that we have a lot of executive directors in attendance today. They would probably put in an E answer, everything. It certainly feels that way, I know, but YPTC is here to support you. So if you need assistance, we're here. All right, let's see what the correct answer is. What is not a responsibility? It is B. Executive directors should not be doing bank reconciliations and bookkeeping.
Greg, you know, we have a term at YPTC that describes an executive director that is doing bookkeeping work. We call them the accidental bookkeeper. We know that EDs wear many hats, but time spent by the ED doing accounting work is time taken away from leading the organization.
Yeah, so hopefully all of our EDs got the answer correct, although they still may be doing that work. But yes, 95% of the people got this correct. Good job, everyone. All right, our next question. Where do you report contributions with restrictions? Is this done through net assets with donor restrictions, deferred revenue, other income, or net assets without donor restrictions? And I would say one of our ASUs that came out not that long ago changed some of the terminology that we use, and hopefully the term that's currently used answers this question. pretty succinctly. All right, let's see what we got here. Folks are getting their answers in now. All right. So the answer is A, net assets with donor restrictions, just as the term would say. When donors impose restrictions for the use or timing of their funds, we need to track that separately from unrestricted funds. George, what do you think about some of the other answer choices that we had in that question?
Sure. So deferred revenue, you could have picked deferred revenue, but only if you're confused about the difference between restrictions and conditions. Other income, sure, if you enjoy explaining things to auditors. Or unrestricted net assets, but good luck explaining that to your board.
Yes, very important that we do segregate the activity that contain donor restrictions from those that do not contain donor restrictions. Very good. 95% of the people got that right. And I think we're at our last question for our first round. What is the primary financial statement required for what are the primary, there's more than one, statements required for nonprofits under US GAAP? So our choices are A, the income statement, balance sheet, and cash flow statements. Is it B, statement of financial position, statement of activities, and statement of shareholder equity? Is it C, revenue report, expense report, and donor contribution? Or is it D, statement of financial position, statement of activities, and statement of cash flows? All right, this could be a little tricky question, but we're talking about the statements required for nonprofit organizations in accordance with U.S. generally accepted accounting principles. And our answer is D. It's our statement of financial position, our statement of activities, and our statement of cash flows. As I mentioned in our first learning objective, we also do have to provide information regarding expenses, reporting them by their natural classification and their function. That is a requirement, but it's not required to be specifically a financial statement. It could also be information presented in our footnotes to the financial statements. All right, 91%. I think we're going to have a lot of high scores here today, George.
Agreed.
All right. We're going to sort of raise the stakes a little bit. We're in our second round. Some medium questions, and they're going to be worth 20 points each. So now let's move on to round two. Our first question: what is the primary purpose of presenting expenses by both function and nature in the statement of functional expenses? Is it A, to ensure compliance with tax regulations? Is it B, to provide transparency on how resources are spent? C, used to calculate the organization's net income? Or D, to demonstrate the effectiveness of fundraising efforts? A lot of choices that sound like they could fit, but there's one here I think that is our best choice. And we'll give you folks just a couple more seconds to get your responses in. Our first 20-point question. All right, so yes, 20 points. Our answer is B, to provide transparency about how our resources are spent. That's, the main purpose of our statement of financial or functional expenses. It really does help our donors, grant makers, and regulatory bodies assess the financial stewardship and operating efficiency of our organizations.
Greg, it should be noted that in addition to being presented in the audited financial statements, this information is also a required schedule in the annual Form 990.
Yeah, so it definitely does have a tax reporting purpose as well. So again, I mentioned a couple of those other answers. They do lend themselves to why it's important, but again, this is our primary purpose. All right, and it looks like a lot of you got this right, 91%. Very good. All right, our second question. In round two, where can you determine the amount of net assets that have limitations on their use? Limitations on their use. Is it A, cash flow statement, B, statement of financial position, the net assets with donor restriction section, C, the budget summary, or D, your payroll expense report? I don't know. A lot of good choices there. We'll see. Folks have all right. I see our poll response is growing here. Good job. All right. Let's hopefully people can maintain their good scores here. Get this
These
one
are
right.
getting tough, Greg.
All right. Let's see what our answer is. It is B, our statement of financial position, the net asset with donor restriction section. That's where we're going to find information about the net amount or the amount of net assets that have limitations on their use.
Greg, you may recall from the questions in the first round that the accumulation of contributions with donor restrictions that are yet to be spent or released from restriction are reflected in the net assets with donor restrictions under the net asset section on the statement of financial position.
Yes. So a couple questions about restrictions. I guess this is an important topic related to nonprofit entities.
Indeed.
All right, our next, there we go. 97% of you got that correct. Excellent. Nice. Good job. All right. Our next question. In a nonprofit statement of activities, revenues are classified based on A, net income and gross profit, B, accrual basis versus cash basis, C, donor restrictions, or D, market fluctuation on investments. And I would add that dealing with market fluctuations of investments, I'm required to say, past performance is no indication of future results. Stop me if you heard that one before. All right. Folks are getting their answers in. Again, a couple of good choices there. All right, give you another 5 seconds to get your answer in here. Okay, the correct answer is C, donor restrictions. For presenting, we most commonly use that columnar approach, as I mentioned before, but we are going to show whether it's a columnar approach or a stacked approach. One section for our activity without donor restrictions and one section for activity with donor restrictions. So donor restrictions is the driver of our statement of activities. Okay, we finally got our first bump in the road here. Going to separate the leaderboard for sure. Now, yes, as accrual basis and cash basis is a decision that we make how we're going to present our activity altogether, but the format and how we're classifying the activity on the actual statement activity is done by donor restrictions. Our next question, which cost should not be allocated on the statement of functional expenses? Is it A, utilities shared by multiple programs, B, direct costs tied specifically to one program, C, rent for a building that houses multiple departments, or D, overhead across departments? So which one of these costs should not be allocated? Cost allocation is huge in the nonprofit world for sure. So we didn't really discuss this in our intro. So we'll see, test people's knowledge. All right, 5 more seconds. All right, the correct answer is B, direct costs tied specifically to one program. Those are the costs that we should not be allocating.
It bears noting that improper cost allocation can cause under or over reporting of the overhead costs. The natural classification of an expense is not used to determine overhead costs. Rather, it is the functionality of the expense. Expenses that are not direct program costs or indirect expenses, such as payroll, rent, or utilities that cannot be properly allocated to a program, are part of overhead. There should be a cost allocation policy that defines how costs are allocated. The methods used should be reasonable and consistently applied.
Yes, yes. Another little plug, part of our series last year, we had a webinar on understanding overhead, so it's not over your head. Anything related to overhead costs will be covered in that webinar, and you can find that on our website. So check that out. All right, so we have again another possible bump in the road. Only 66.8% of us got that right. So there's going to be a couple of experts results, but I think maybe the back of the line is starting to catch up. All right, our next question. Where do nonprofits report long-term assets? Long-term assets. Is it A, the statement of functional expenses? B, the statement of activities? C, the payroll ledger? Or D, the statement of financial position? Where do we report our long-term assets? All right. Our responses are coming in. And the answer is D, the statement of financial position. That's where we're going to be presenting our long-term assets. Our assets are reported on the statement of financial position, and our long-term assets specifically. This is our property and equipment, land, building, vehicles, and the value and balances of these assets, along with the accumulation or accumulated depreciation we've taken through the years, is reported on our statement of financial position. It's not a current asset, but it is still part of our statement of financial position. I like that one answer, the payroll ledger. Although at YPTC, we do consider our employees to be our most valuable assets, the payroll ledger is not the correct answer. All right. Didn't fool anybody on that one. Almost 96% of us got that correct. So good job. All right. So you've made it through the first two rounds. We're up in the stakes here. We're now on to round three. There's only 3 questions here in round 3. So do your best. Our first question, worth 30 points. Where would you classify revenue received from ticket sales from a fundraising gala? All right, ticket sales from fundraising gala, and we've been through them all. We've hosted a few. Is it A, special event revenue on the statement of activity? B, fundraising expense on the statement of activities? C, net assets with donor restrictions on the statement of financial position? Or D, accrued liabilities on the statement of financial position? I have a little thing blocking the answers there. I assume that's what that last answer said. Spoiler alert, it's not going to be accrued liabilities. All right. Couple more seconds to get your responses in. Here we go. The correct answer is A, our statement of activity or special event revenue on our statement of activities. That's where we're going to reflect the revenue from ticket sales for our gala.
Yes, ticket sales from fundraising galas are often treated as part exchange transaction and part contribution, as the value the attendee receives in exchange for the ticket is often less than the amount paid. Revenues from fundraising galas are often reported as special events revenue on a separate line item in the statement of activities net of their direct expenses.
Yes. This definitely is one of the more complex accounting treatments. for something as simple as a ticket. So it does trip up some people, but it doesn't look like it tripped up this group. 89.6% of the folks got that correct. So good job. And again, that was one of our hard questions. Our second hard question is, again, we're at 30 points. Which factor is an indication that something is an exchange transaction? An exchange transaction. Is it A, the primary or the payer's primary intent is to make a gift? Is it B, the nonprofit provides goods and services of commensurate value? Is it C, the contribution is voluntary and unconditional? Or is it D, the funds are subject to donor restrictions? So we're looking for something that lets us know we have an exchange transaction. A lot of potential answers here. Definitely issues that we are dealing with determining revenue. We might be referring back to our flow chart, our decision tree flow chart on revenue recognition to get this one correct. The answer is B. The nonprofit provides goods and services of commensurate value. That is pretty much the definition of an exchange transaction. There is an exchange of goods and services for commensurate value of what's being received from the resource provider. Unlike in a contribution, when the nonprofit provides goods or services of commensurate value, we call that earned income. The resource provider is receiving something in exchange for the payment. Now, sometimes we're not directly giving the resource provider something in exchange, but if we're giving society as a whole, that would still be considered, or I should say, when we're giving society as a whole, that's going to be lends itself to a contribution. But we could be doing something directly for the resource provider. That's probably going to be determined to be an exchange transaction. All right, 92.4% of us got that correct, so good job. Commensurate value, key terminology that we see to determine that we have an exchange transaction. All right, our last hard question. When would you record the value of 20 hours donated marketing services? Is it A, a sticky note from the finance director's drawer? Is it B, the statement of financial position? C, the statement of activities and notes to the financial statement? Or is it reported on the statement of cash flows? 20 hours of donated marketing services. You know, George, we have a great marketing team here that puts together our webinars and other presentations. So
Certainly do.
yes, definitely like that, those marketing services. All right, let's see what our correct answer is. Oh, it is C, the statement of activities and notes to the financial statement. When we're required to report some in-kind activity, we're going to report that as a separate line in our statement of activity, aside from cash contributions. And we're also going to have the offsetting expenses, the marketing expenses, if you will, in order to be in compliance with GAAP, with generally accepted accounting principles. All right.
This is a GAAP requirement because it's crucial for accurately reflecting the full value of revenue, ensuring transparency with donors and stakeholders, and for providing a clear picture of the organization's financial health by understanding the true cost of goods and services incurred, whether the costs were paid for or donated. And that's different from a requirement from the GAAP, where they just want you to dress fashionably at reasonable prices.
Yes. Don't fall into the gap. All right. 89.5% of you got that correct. Good job. And now we are at our last three questions, our expert round. Going to separate the experts from the novices here. And again, we may have not covered this earlier. Let's see how we do. All right, Nora. Nora wants to also have sticky notes. A lot of sticky notes. Probably that's a messy desk, but no, I appreciate the humor there. All right, our first 50-point question. Which donor-imposed item will delay revenue recognition within your financial reports? Is it A, donor-imposed restrictions on program use, B, unrestricted contributions, C, time-restricted contributions, or D, donor-imposed conditions? Which one is going to impact, delay the revenue recognition? All right. Definitely, you look at these responses, it's going to trigger a lot of things related to revenue recognition, but only one of these is going to delay the recognition. Okay, another 5 seconds as we're getting close to the top of the hour. The answer is D, donor-imposed conditions. That is going to affect our revenue recognition timing. Donor-imposed conditions delay the recognition because they create a barrier that must be overcome before the nonprofit is actually entitled to those assets that are promised from the resource provider.
If you recall from the decision tree that we saw earlier, if there is a donor-imposed condition with the donor's right of return, if that condition is not met, revenue cannot be recognized at that time. Rather, the revenue will be recognized only when the condition is met. Donor-imposed conditions are most commonly found in cost reimbursement grants and matching grants.
All right. So we got only half of you. Okay, like I said, we're going to separate those experts from the novices. Our next 50-point question is, in which account would you record cash received that must be matched before the nonprofit can keep those funds? Is it A, contribution revenue, B, net assets with donor restrictions, C, refundable advances, or D, the fingers crossed fund?
Yes. I'm doing that right now.
Yes, I think the finger crossed fund has that account we love in the chart of accounts, Ask My Accountant. How many entries are in the Ask My Accountant account? That's a fan favorite of us at YPTC. All right, moving quickly here. Our answer is refundable advances. Advance payments on a condition or conditional contribution is typically referred to and reported as a fundable or refundable advance.
Yes, a refundable advance is similar to deferred revenue. Deferred revenue is used for earned income, and refundable advance is used for contributions, but never vice versa.
All right, it's our last question of our expert round and of our quiz today. How are restricted contributions for long-term purposes recorded or reported in the statement of cash flows? Is it in A, the financing activities, B, the investing activities, is it C, the operating activities, or is it just a non-cash adjustment? So these are restricted contributions for long-term purposes. Going to buy me a building. Where do I report that in the statement of cash flows? Definitely our hardest question here because nobody cares about the statement of cash flows. It's definitely the unwanted stepchild of the nonprofit financial statements for sure. Okay, the answer to our final question is A, financing activities. When we're dealing with long-term funding, that's covered in our financing activities. All right. So I think this was the only question that had a less than 50% correct rate. Not surprising, that definitely is an expert level question. All right, so that's going to wrap up our questions. If you're playing at home, I'll give you a minute just to add up your scores. And once you do, I'm gonna put on a poll question. You can enter your score there. We're going to see if we have any experts. So how many points did you get? Is it 50 or less? Between 50 and 150, 160 to 250, 260 to 380, or did you get a perfect score? In which case, one of our talent acquisition team is going to be reaching out to you for opportunities at YPTC.
No matter how you scored, we have additional information and resources on all of these topics on our website.
Okay. I'm starting to see some people, perfect score. Yes, I recognize you, YPTC employee. Mm-hmm. Of course, you got a perfect score. Let's see how some of the other folks did. All right. We got a lot of people between 260 and 380. That's a very good job. I think that definitely demonstrates a good knowledge of nonprofit financial reporting and accounting. So good job, everyone. All right. So just to wrap things up at the top of the hour, let's review some of what our learning objectives were. We talked about the key components and key features of nonprofit financial statements and some of the financial statement terminology. Hopefully through our that section and then our quiz, we also understood the nonprofit accounting guidance and some best practices, and also accuracy and compliance factors that affect the way we do accounting and report accounting, making sure that we are in compliance with GAAP, our generally accepted accounting principles.
In conclusion, understanding these components is essential for maintaining transparency and compliance, ensuring the continued success and integrity of your nonprofit organization. Please use these insights to strengthen your organization's financial management and reporting practices.
All right. So thank you again, everyone, for joining us today. Our webinar next month is going to expand on some of the foundations that we spoke about today, and it's going to sort of cover how we identify red flags in financial statements. So hopefully you can join us next month. And for everyone here at the YPTC studios, thank you for attending. George.
Thank you.
Say goodbye,
Good to
George.
see everybody. Bye-bye.
You're supposed to say goodbye, George.
Say goodbye, George. Goodbye, George.
There you go. All right.